Welcome to this special edition of Beyond the Bottom Line. In this special episode, Miguel breaks down some of the biggest tax and strategy changes affecting businesses right now, including bonus depreciation, QBI, R&D credits, and business structure planning. And near the end of the episode, Lucy will join us with a few selected listener questions. Now here's Miguel.
Thanks for joining. Today we're going to talk about the tax changes that have happened over the past year. And I'll say that I'm also grateful that I think for the first tax season, maybe since 2020, we're not worried about retroactive changes that will change the tax year we're filing. So in the past, whether it was PPP or ERC or some of the tax revisions that we've seen two big ones in the last 5 years that have significantly changed. What we're grateful for is that finally Congress took some action. Congress acted. We got what we wanted last year, and they've essentially helped establish what the playing field is. And what we want to help our clients do is plan and strategize in that environment. It's hard to do when you don't know the rules. Let's talk about timeline, when we need to file, when we need to start thinking about things, and looking at an overall goal for your investments, for your business. And with that goal in mind, thinking through how the rules affect what's happening. What are the main deadlines? What's on the horizon? What's changing? What's different? And then we'll talk a little bit about the strategies that we can extrapolate from what we're talking about here. And we'll end with some key points on what you should know. I'll share a little bit about me. I am the co-founder of Centurion Firm. We operate through a number of brands that are specific to certain segments of the business. Tax strategies are different for different kinds of businesses. So what we do is we spend a lot of time thinking about brand, thinking about the content we put out, and we change that content and we change those strategies for those specific verticals. I've worked with big investors and operators. I've worked with small investors and operators. And what's true, I think, when you get to the bigger sizes is they understand how to use tax as a strategy. So my goal, very simply put, is to try and make all of our clients as savvy as they can be around tax without actually having to learn the specific tax rules or deal with the tax forms. So a little disclaimer about what we'll cover here. Our content is creating context. It is encouraging, I think, a direction of savviness that we want for you. We won't be getting into the forms and what lines to put things on. That's what we worry about. But we want you to know what things are available. And the way that we work with our clients best is we work as a tax advisor. And that means that we're meeting with our clients once, 2 times, or 4 times a year, depending on your package. And what we're doing on those calls is we're going over the strategies that specifically apply to you. And I would say that in the most successful arrangements, that relationship goes 2 ways, meaning that we are, number 1, bringing you strategies, but number 2, reacting to the strategies that maybe you've read about, maybe you're interested in, maybe in a mastermind or a peer group someone brought up and said are really valuable. And that's something that we believe works best when you have a sense of what those available strategies are. So what's really cool about those advisory engagements is we get to see our clients level up. And that's what we're doing here is we're going to level up your tax knowledge about what's different for this year. There's 3 ways to think about what we do. And I think there's 3 ways to think about what you need when it comes to a tax issue. The first is compliance and controversy. That means that there's some kind of a letter from the IRS or the state tax authority. They've said you owe something, or they're saying that they have questions. Those tend to happen. We don't want them to, but they do happen. And we have a line of service around making sure that that gets resolved in the most favorable and fair way. And you might not believe this, but the government is very lazy about what they think is an issue and the way to solve it. Their issue is, we found this thing, you owe us money, pay us or protest. And the way to protest is typically very, very difficult. So I typically will always say, you want to work with an expert that knows how to work the correspondence, work the letters, work the timeline to make sure that you get the most favorable outcome. The second we'll talk about is just reporting and diagnostics. And that's really the brass tacks of tax and bookkeeping. That's the tax return filing. That's making sure you have an annual report. That is level one, really, of handling compliance around your business. Oftentimes we have clients come in, they say, hey, I want the strategy. You can't get there unless you've got a strong base at the reporting and diagnostics level. So we always say, hey, we've got to start here. And that's the springboard that we jump into advisory. That's looking forward. That's not just looking back, which is what reporting and diagnostics is. It's retroactive. Tax and advisory is looking forward. What does the year look like? Do you have a kid graduating high school, going to college? Do you have a couple grandkids that you want to start thinking about your trust and planning, estate planning around that? So advisory is really where we start to think about, can we purchase another asset? Are we going to sell the business in the next 2-3 years? It's really where we get most value. And again, it is the secondary step after we have reports and diagnostics. So when we talk about tax and accounting, I just want to set the floor here and say that there's really 3 things that we talk about. The first is going to be compliance, rules, and regulations. So we won't talk about local and municipal, but when we say compliance and regulations, what we're talking about are the federal, the state. Those are the first rules that we're going to deal with. And the second thing that we look at from an accounting standpoint, net profits. We're not focused on gross. We're focused on net. And that's why we want to make sure that we've got the reports dialed down, because only when you do your accounting can you actually figure out what your net is. And the reason it's such an important component is because for those that are in the service space or self-employment space, even as an Airbnb, if you don't do it right, you can be subject to this self-employment tax. It takes a big chunk out of your net income. So we've got the tax, which is focused on the rules. We've got the accounting that gets us to our net profit. And then the third component is really the municipal. What are the rules that are happening locally, whether they're property taxes or if you do Airbnb, these are called ITOT. They're sometimes the gross revenue that gets applied there. If you do e-commerce, it's sales tax that's by jurisdiction. And in certain cases in LA and New York, there's local taxes there that we need to be aware of. So those big 3, which are going to be the big compliance, tax, federal and state, the accounting, and then the municipal, are going to be the things that we work through when we talk about changes or planning. We're really going to focus on the top 2, which has to do with the tax and the accounting. And today, not so much the municipal rules. So let's talk about some of the changes. And one of the biggest ones has to do with depreciation. Depreciation, when you have it, if you do STR, if you do Turo, but even if you run a business that is purchasing, whether you're purchasing a building or you're purchasing assets in the business, depreciation is going to be your tax shield. So it's a really important concept that essentially is deciding whether you are able to deduct the full amount of the purchase or how much of it you can deduct. And the reason that's important is because you're typically financing these big purchases, but depending on the rules, even if you finance it, you can take a full deduction on that amount. So the rules used to be, until we got tax reform, was that the bonus depreciation was being phased out. Essentially, what we got back is 100% bonus depreciation. So again, you buy a big asset, and instead of having to apportion that out over 5 years, or in certain situations, instead of getting 80%, what you're now able to do is get full 100% bonus depreciation. So those are the tax rules. There's some qualifications that need to take place in order to get that. It has to be a tangible asset. You have to touch it. Essentially, it's not your intangible assets. It's not goodwill. It's not the acquisition of a website. This is an actual thing that you can touch. The second thing is that it has to be purchased. It can't be leased. It has to be bought from an unrelated third party, and it has to be at least 50% in the business. And this is important sometimes with business vehicles where, you've got a business that is very high margin. You buy a very expensive vehicle. I'll use this as the example, maybe a $250,000 Lambo. but the business that you bought it for isn't your main business. It's maybe 20% of your overall actual time spent, and the vehicle itself is used for personal as well. So now you have a small percentage on that. So you really want to make sure that these are things that you can establish a fact pattern around to make sure that it's a primary business vehicle. And also important to note that if the business is 60%, it still qualifies for bonus depreciation. Vehicles would qualify for 179, but I'm just using it as a simple example. If you use it 60%, well, your bonus, even at 100%, is only going to be on that 60%. So just note that you really want to establish a fact pattern and be comfortable with the fact pattern where that business use is as high as possible. I also want to talk about QBI. Now, this is something that a lot of our clients don't really notice. They don't really zoom in on it, but it is on your 1040. And essentially what it is that if you have a pass-through business, even your sole props, but your partnerships, your S-corps, if you have a service business or a business that is profitable, what you get with QBI is a good tax benefit that came into effect in 2017, actually, with the Tax Cuts and Jobs Act, which essentially was trying to level the playing field between a C Corp tax rate and a pass-through tax rate. I think that's really important because I think a lot of people start running away with, okay, well, in the C Corp, I get a 21% tax rate. In an S Corp, it gets taxed at my marginal tax rate, which is 30 to 35%. Why wouldn't I just go with a C Corp? This is your reason. The QBI deduction is a reduction of 20% of your income on your taxable income. So essentially, if you had 100 pass through, well, instead of getting taxed on the full 100, you get a deduction of that 20%. So you actually get taxed on 80. So that QBI, again, it's something that our clients don't necessarily zoom in on. I think if you're a client, ask, because QBI does get phased out. The phase out for married filing jointly, I think that might be 556, might be for 2026. But once you start getting above that, it starts phasing out, and then it phases out to zero, actually. So in certain situations, a C Corp can be better depending on your income, but it really depends on what you expect to make every year. Because if you've got one year where that income shoots up, maybe it's $1 million, sure, in an S Corp, you're going to get taxed on all of it, and you're going to phase out of that QBI. But if in the next year you're back between that, you figure out a deduction strategy, or maybe staying at that level is going to require hiring more people, and now you're 300 to 400, QBI is going to come back and be an amazing strategy. So what we don't want to do is have clients that kind of see the pathway to $1 million in EBITDA and say, okay, I'm going to be here forever, I'm going to be a C Corp, and then reinvest, and then they're back in a situation where the C Corp, because of the double taxation and the dividend tax, is now starting to be worse. And I also say, I want to double click on that dividend tax. When you are a C Corp and you're bringing income back to the shareholders, you get taxed at capital gains rates. So it's that 21% plus another 20% on what you take back. So the name of the game with QBI is going to be better if you're clearing the chips off the table every year. Again, there's a level where it starts phasing out, but for many businesses that, they've got EBITDA or net income anywhere from 100,000 to 200,000 every year, and your salary reduces that, right? So you've got a salary and you've got that healthy 100 to 200,000. A lot of our clients are, in the grand scheme of things, they're small and medium-sized businesses. QBI is going to be really, really valuable. And the reason that we were worried about QBI is because it was going to sunset. Congress loves to do that. They say, hey, we're going to bring this amazing tax strategy that's going to get us elected back in office. But the way that we balance the budget, it's all theoretical. We balance the budget in 2030 by removing it. We now have that back, and Congress has to figure out how to not shut down, which it's not really good at. And it's got to figure out how to reduce the deficit, also not really good at, but that's not our problem. I think our view fundamentally is that if you are a business owner, that capital staying in your business is far better allocated than it is in the government. They can figure that out, but the good news is that QBI is here to stay. And what it does from a planning perspective is it gives us clarity that the S Corp or the pass-through, really the S Corp, is a very strong tax planning tool that is going to be true for the next X amount of years, for the foreseeable future. So a quick point on deduction updates. We had the SALT cap increase, and that's really important for those that are in high income tax states. It's also important, I'm here in Texas. We pay local taxes, a high amount of local taxes on property taxes. So before that was phasing out for the itemized deduction at $10,000. So even though I'm in Texas, I don't pay any income tax. I was definitely paying more than $10,000 a year in property taxes. I was losing that benefit. I was losing it. So, if it was $12,000, I'd max out at the $10,000. And, I really don't want to buy a bigger house because it's not tax favorable. Bigger house would be more property taxes. Today it's at $40,000. So again, I'm giving my specific situation, but if you consider somebody that lives in a state like California, where I used to live before I realized how bad it hurt from a tax perspective, I would have income tax on top of what I paid in property taxes. Property taxes are lower in California, but they definitely make it up on the income tax. So that income tax, again, same dynamics apply. If it was $30,000, you got a benefit on $10,000. And then to clear the itemization deduction hurdle, which you've got property taxes, but you also have home interest, you had to clear $24,000 just to use a round number. Maybe you didn't get there. Maybe you're at $22,000, so you just got the standard deduction. Now, that's a problem if you actually had $30,000 in income taxes, right? Because you've got $30,000 for income taxes. It doesn't matter. $10,000 was getting netted out, and then $10,000 added to your interest. You were under the standard deduction. You took the standard deduction, but now that math is flipping. So now if you've got $30,000 on the income tax piece, you've got another $10,000 on home mortgage interest. You have a $40,000 deduction, which is now far exceeding the standard. So you're actually getting a deduction up to what you paid in income taxes. You can still see that it caps out at $40,000. So, high earners are still losing that benefit, but you're losing it at a 4x multiple of what the previous limit was. Now, your tax advisor and your tax software, if you do it yourself, will catch that. It's just something to note to make sure that you understand when it comes to itemized versus standard deduction. It's really important to note as you do tax planning and you start looking at the year ahead. What could have happened, what happened with our clients is that if you were withholding at a certain rate on your W-2 because all of a sudden you owed money, these new rules came into effect. Now you didn't withhold enough because you took the standard and the previous year you had a high itemized deduction. Well, you probably updated your withholding to make that up. I don't want to owe taxes. I'm going to adjust my withholding. Now we've got to reverse that. So now it's a good opportunity to look at withholding and say, wait a minute, my itemized deduction, look at it with your tax return. My itemized deduction is now much higher, and therefore I don't need to withhold as much on my W-2 because I got this big refund. Now, that's something that the CBO, and there was an article from The Economist came out recently saying that tax refunds are going to be bigger than ever. It sounds very Trump-esque, right? It's going to be the greatest tax refund like you've never seen before. The jury's still out on that, but these are some of the reasons why that estimate is there. And I think the action item from that is maybe you don't need to withhold as much if you have a really big refund. So something to think about. The second component is really important for our businesses that are working on dev. And I think this is going to get huge, and it's starting to blow up. We're starting to see it with R&D expenses. So any business that invests in their technology by actually doing technology, I'm going to say a misstatement like that, just to kind of drive home the point that you have to do things in the science to get the R&D tax credit. But previously, what the code was saying is, look, if you're a software development agency or you're a tech firm, and this really hurt the small ones, you earned $100,000, you spent $100,000 on development, you'd say, hey, I'm not profitable. Well, what the rules said before, starting in 2022, I believe, was that now you only got 20% of that benefit. So you spend $100,000, you get a $20,000 deduction, and that made you profitable. You now had 80,000 profit. You now had to pay taxes. You had less capital to run your business because now if you're a C Corp, you're paying 21% of that to the government. And it really did hurt the small businesses that were trying to conserve capital for the future. Now that's back. And by the way, it's not just dev spend. What I mean by that is it's not just software dev spend. It's any process that is uncertain where you are investing for a new outcome that doesn't already exist. It sounds really professorial, but the point is that if you're developing a methodology and there's science involved, it can be absolutely physical, engineering, mechanical engineering. Those are things that we look at and say, hey, there might be a tax credit here. We've started servicing companies in the wine space who are working on a new methodology for a new batch of wine, CPG brands that are doing, consumables, whether that's things in the health space or in the wellness space. These are things that are qualifying. And I think the risk of the R&D tax credit in the past was that, wait, I don't want to take this credit if I have to spread out my costs. That is back. And we had some clients that didn't take the R&D tax credit because they're like, hey, whoa. This was great, but now that I have to amortize my expenses, spread those expenses out, and have higher taxes, I don't want to take it anymore. So what the IRS came up with is a way to go back and claim those credits. So we're working on this like crazy. The floodgates are open, and we'd be happy to help you with it. But essentially, if you didn't take the tax credits from 22 to 24, the IRS, if you qualify as a small business, that threshold, I think, is 31 million in revenue. If you're under that, then what you can do is you can essentially go back, amend those returns, and get refunds. And refunds, I think, are a good strategy because they come with interest. We've seen some refunds come in, and that interest line, I think it's like intellectually satisfying or emotionally satisfying, but getting money back from the government with interest is a tax play, period. So if you think you qualify for R&D, feel free to reach out to us. We can help qualify you within one call, estimate the benefit in one call. It's not a sales call, it's an estimate call. So feel free to reach out. So here are some other things that have kind of come up. Retroactive refund opportunity. I think this is something that's caused a lot of confusion with our clients and our tax team ourselves. So your overtime and tips should be separated on your W-2. Let me just say that should. And sometimes they're not. So we've actually seen some situations where our clients have gone back to their employers and say, hey, I think this should be restated. But let me tell you who it doesn't apply for. It doesn't apply if you're on a strict salary and you get a bonus. That's not what overtime is. This is actually where it's defined as overtime and you're paid for specific overtime. Tips as well show up on a separate box on the W-2. Those are also tax-free. So your tax offer should do that. But I think the point here is, number one, if you have employees, it could be a good strategy to roll out an overtime policy. Check with legal. There's a lot of legal stuff around that, especially if you're in California, New Jersey, New York, Illinois, where labor laws are very tricky to manage. But certainly, I think from a tip perspective, that could be a little easier. Now, I don't know how you feel, but I'm personally getting fatigued of adding a tip to everything I buy, even if I buy a muffin now where, I think my buddy said I've got a rule, like if I get my food while standing, I'm not tipping. I've just kind of resolved just leaving a tip on everything. But the benefit is that they're tax-free. And in some ways, this is an employee benefit. So it's a way to create a tax-free incentive for employees if you have a business that is friendly to that. The last thing I'll say, which is important as well, an employer child tax credit. I think it's also something that we're thinking about with clients as an employee benefit. There's been a baby boom. We've certainly been a part of it, as I've doubled the amount of kids I had over the last 5 years. So would this be an interesting benefit to employees and people you're trying to recruit? I definitely think the answer is yes. So that is a strategy that we can look at with you, and something that's changing, I think, the landscape of what benefits employers offer. We want to offer tax-friendly benefits. Our people want tax-friendly benefits. And the last thing I'll call out is really important for our shared economy clients. If you are on an STR platform, if you rent your car on Turo, get around. But also, if you sell anything on a platform, whether it's eBay, if you sell on Etsy, the threshold has, I think, reset to reasonable. And it's essentially reset to the old rules. So it used to be 20,000, and then the rules wanted to change it to 650. So essentially, if you sold a guitar or a bike on eBay, you were going to get a 1099K, and now you had to report it on your taxes. And essentially now it's a little more reasonable. So unless you are kind of a serious seller or a serious renter, serious host, whatever word you want to pick, now you will get 1099K. Now, I will say what I've always said about 1099Ks, but you need absolutely to report all your 1099Ks added up. Now, sometimes things get duplicated. Sometimes the platforms report things funny. It doesn't matter. There's a way to reconcile against what you actually receive, and that's important you do. So what I mean by that is if your 1099K, let's say you were over the 20,200 threshold, if it says you earned $60,000, but you say, wait a minute, Miguel, you guys did our QuickBooks or our Xero, and when I go into the P&L, it says I only made $52,000. Why am I going to report on $60,000? Am I going to get taxed on that? We solve all that. And the way to do it is that your line 1 on your P&L, whether you file it on a Schedule E, a Schedule C, an 1120S, an 1120, needs to start at the sum of all your 1099Ks, or the IRS's computers are going to flag you. And they're going to say, hey, you underreported. So you said 52, we said 60, and we're going to tax you on the difference in 8, and there's interest and penalties. That's not good. So what essentially you need to do is you need to reconcile between the 60 and the 52, and the way to do that is it's typically commissions, fees, refunds, chargebacks, whatever it is. So you start at 60, and then you net to the 52 by adding in the commissions, the refunds, and things like that. So that's for your tax accountant to do. If you're a DIY person, you need to do that on your own. And the point is, if you don't, you're going to get a nasty gram from the IRS. So conclusions. A lot of the things that have changed are reflected on the tax forms. So it doesn't mean that your tax return is going to necessarily get complicated for you. Your tax advisor, your tax team, they have a process. I hope they have a process. We certainly have a process to make sure that we're checking the opportunities that come from this, but also to make sure that we get it right. I'm far more concerned about making sure that you know what the rules are so that you can take action, whether that's getting a 100% bonus, whether that's developing a strategy to develop technology in your business. I'm a part of a few business groups. I'm a part of Vistage, and a lot of those businesses are not, I would say, traditionally tech forward, but they are developing some kind of AI in their business. AI is tricky. AI can qualify for the R&D tax credit, but it doesn't always. There needs to be some back-end code, and sometimes the strategy is developing some kind of a repository for code, still working in no-code solutions, but checking that box from a tax credit standpoint in order to qualify. So I think the future is very bright. I think the way that I envision businesses in the future is that they are going to be developing tools, whether or not they're plumbing, HVAC, or a retail storefront, that are specific to their business. I think the world of just buying the software you need to solve your problems is changing. They call it the SaaS apocalypse. And I wouldn't be surprised if 2-3 years from now, 80% of our businesses that weren't tech first are tech second, tech third, whatever you want to call it, but have some level of R&D tax credit. The other thing I would say is on the QBI. What you should hear is we need to envision the future and plan around it. There are times to change your entity structure. I was comparing an S Corp and C Corp, but certainly if you're a single member LLC and you're getting that 15.3% self-employment tax chunk ripped out of all your net income, you probably should switch to an S Corp. Those are all things that we decide with the future in mind. And I say this to my team, and I say this when I talk about tax planning, is tax advisors don't have a crystal ball. We don't know what the future's like. What we have is a map. So if you tell us what that journey looks like, really in the sense of number of customers, amount of revenue, the cost structure it's going to take to get there, we can usually model out some level of EBITDA, some level of net income that is going to tell us whether it's better to go to S Corp, stay in S Corp, or eventually plan on moving to a C Corp and staying as a C Corp. And we put out recently a blog on S Corp versus C Corp where I get into the QBI dynamics. I will find a way to link to that when we send this out. But I certainly think that's a good start for understanding what the dynamics are at play to switch your entity system. The payroll system, I think, is a really important point for employers. I would say that the second point there, besides just getting it right, is to talk about it. I think we want to talk about tax favorable benefits, and we want to roll them out where possible. And the last thing I'll share is we didn't really talk about it as much because we do so much content around cost segregation, but I'd be remiss to skip it. Essentially, cost segregation, the purchase of a building and accelerating depreciation is even better than it was before. It was still good, and we were still doing cost segregation studies during the dark ages of 22 through 24. But now that strategy has just gotten super powered. So if you're buying a rental that's going to be an Airbnb, you're going to want to look at whether cost segregation is something that benefits you. Certainly if you're buying a commercial building, that's going to be something. Now, hold period and how quickly you expect to sell it does impact the benefit of it. Again, what we do is we'll get on a call with you. And again, it's not a sales call, it's an estimate call. We can estimate what the benefit is there.
All right, here's Lucy with today's listener questions for Miguel.
If we are building internal system automations or custom reporting tool for clients, does that count as R&D?
It can. And what I'll say about that is that there needs to be some kind of science. There needs to be some kind of actual tech that you touch or review. And typically what we're doing with that is we're understanding, is there a code base or is it 100% no code solutions? The R&D tax credit and the IRS do not like 100% no code solutions. So I'll give you an example of that. If I am using something like Zapier or Make.com and I'm connecting, I don't know, Slack to, some native dashboard reporting tool, that doesn't qualify. But let me qualify that. If you have a custom HTML dashboard that gets spun up, and today I could do that. And if I could do that, you can do that. So I could prompt Claude to give me a dashboard, to give me the code. And then what I'm doing from there is I'm probably pushing it to GitHub. And then I am getting some kind of intermediary there to actually store the code. I've now qualified for the R&D tax credit. So there are levers and things that actually are good hygiene. I'm not technical myself, but we spend a lot of money on an outsourced development agency. We do the R&D tax credit where our time does qualify for R&D because we are leaning on a partner to check off the tech piece. But again, I think the future is that business owners themselves, technical or non-technical, are going to figure out and be able to check that box on their own. So, I've done it. I've asked Claude, like, hey, where do I do this? What is GitHub? And it's been a learning experience. So I would say maybe. And the way to qualify that is maybe there's a conversation that you can have with our team where we kind of give you specifics on what would get it to that qualification. Just so you understand, the amount of spend times 10% is what the credit is. So if you spent, typically, if you spent $20,000, we're talking about a $2,000 credit, might not be worth it. But certainly when you add a zero to that, you start looking at numbers that actually change. They're really changing. Because again, your income, let's assume that your income hasn't changed, right? So, you're still making $100,000, you're still getting taxed on $100,000. That tax credit is actually going to offset the tax you owe on that $100,000. So It's a tax credit, not a deduction. And in the order of valuable strategies, the tax credit is like magnitudes above a deduction for tax advisors.
Thank you, Miguel. We have another question. How do you know if a property is a good candidate for cost segregation?
Yeah, that's a good question. We focus on properties that are between $400,000 and $2 million in value. Certainly, if you're above that, you certainly have a strategy. But the reason that we focus on it is because we do focus on smaller and medium businesses. Our mission is to bring Fortune 500 tax strategy to businesses of all sizes. So what we've essentially determined is, look, if the property value less land is even $300,000, you start to see tax savings of about $3,000. And it just moves in magnitude above that. And that land versus property value is really important, because if you do buy a place that's $400,000, it depends on where it is, but it could be that the land is worth 70% of that. So now you've got a really small base to do cost seg on. Cost seg isn't done on land. It's a joke in the accounting community that tax strategists on TikTok say you can depreciate land. Anyway, the point is, it's not funny. The point is that land is a removable component. So once you remove land, that's the base. If that base is $300,000, you're starting to look at an opportunity, and it really just gets better in multiples. So, I mean, we've had $400,000 properties that knock off $12,000 in taxes. But again, it depends.
What's the best way to connect with you?
We are, let's see, I think we're showing up our Centurion Firm website. Lucy, what's our email? Do we have info@Centurion?
Yeah, info@centurion.com.
Okay, info@centurionfirm.com if you just want to start a thread. If you want to give us a lot of context up front, we've got a contact us button on the Centurion website, and we've got actual people. They're not AI agents yet. We've got a team and someone that heads that up that is going to make sure that they get back to you. And look, again, we just want to make sure that we add value, give you some context or insight that helps you. And yeah, if there's an engagement on the other side, great. But really here to help in any way we can.
That's all the question we have from the audience today.
Thanks, Lucy, and thanks everyone for joining. Thanks, everybody.
Thanks for listening to Beyond the Bottom Line. This podcast is brought to you by Centurion Firm, bringing you Fortune 500 tools and strategies to help small businesses and other organizations with tax, accounting, and technology implementation that maximize cash flow and long-term value. Learn more at centurionfirm.com.